Well, that is perfect timing. We actually went live at 6 p.m., and that is great timing. I am anticipating another wonderful, informative night. Uh, and so I'm going to give a few minutes to get on, and we are going to into our our all right. Did I freeze? Pastor
Yes, yes,
Michelle?
yes. Good evening, everyone.
All right, I'm moving now.
Good evening, everyone. We are preparing. We're coming in, and we have a very special guest for this evening, Khash Benham, who I've had a great time talking to. I had a great time talking to him last year. He shared with us last year on the same topic of real estate, borrowing, investing, private money lenders, when to buy, when to sell. And he will be sharing again with us tonight. Phenomenal uh, man who really knows his stuff. And Apostle, are you back yet?
Am I back?
I think so.
All right. All right. I'm back. Tina says I'm back. Okay. Oh my. Wow. Wow. All right. Wonderful. Well, good evening, everybody. And we just give God glory for this evening's Wisdom for Life session. We had a phenomenal time last week, and our expectation is the same for this week. I'm glad that you have joined us. I want you to tag everyone that you know. I really want you to tag our young adults. I want our young adults to start investing in property. I want them to own property. I want you to tag seniors. I want you to tag everyone that you know. Tell them to join us on tonight because we're getting a wealth of information that is going to help guide us through this next season of our life. Our scripture that we use for our wisdom session comes from Psalm 112 and verse number 5, where it speaks of a good man shows favor and lends. But watch this, he will guide his affairs with discretion. And this word discretion means that he guides his affairs with wisdom from knowledge. He has an understanding and he has knowledge. So, what we're giving to you this evening is knowledge. We want you to be knowledgeable about the housing market. We want you to be knowledgeable regarding rates and financing, refinancing, HELOCs, you name it. We want you to know, and we want you to be savvy in every one of these areas. And so we have with us tonight a wonderful man that I have worked with many times in the past. And what I love about Khash, his name is Khash Benham. What I love about him is that he is, I believe, one of the best mortgage brokers that I know. And he'll tell you a little bit more because he goes beyond that. But I believe he's one of the best in that he's also very creative. He's very honest. He's a man of integrity. And it's hard to find people of integrity in this type of business. And so Khash Benham is with Concierge Lending. And he's going to come. Khash, how are you this evening? You have to unmute. Unmute yourself.
You.
All
Hello,
right, there
everyone.
we
Sorry
go.
about that.
That's all right. It happens all the time. We all do it. It is so great to have you. And I want to just open it up. As we have spoken about earlier, we're going to have a time of Q&A. But I want you to just tell us first of all, a little bit more about yourself, what you do, your role. He is the founder of Concierge Lending. And so I want you to just talk a little bit about what's happening in the market and what we can all expect. So tell us about yourself, a little bit more about what you do, and then what's happening in the market these days.
Excellent. Thank you, Dr. Chess. Hello, everyone. My name is Khash Benham. I am a career mortgage professional. I've been in this industry since the late 90s, so over 20 years, closed over 10,000 loans.
Wow.
Oftentimes I've been in publications and whatnot, top 1% of the nation in originations and things of that nature. So a lot of knowledge, a lot of scenarios that have come across my desk, based out of Southern California, but we do nationwide lending. And today I just wanted to go over a little bit about the craziness that's happened in our industry over the last 18 months and how COVID specifically has affected our industry, and if that's helped make it a better time to buy, a better time to sell, refinance, things of that nature. And I don't know how many of you pay attention to the market, see all the advertisements when rates are low, but I'll tell you this, when you see more and more advertisements out there, that means rates are low, because that's the time that all these big banks will spend the money on advertising to try to capture as many people as possible. And right now is a fantastic time. You know, COVID unfortunately affected a lot of the nation negatively. And one part of that and how it affects the economy is that when the economy gets negative, or when things go down at all, it also brings rates down. It's directly tied with the economy. When everything is booming, rates go up. But because everything fluctuated, you know, down, rates went down with it. We hit absolute lows in 2020, and the turn of 2021, it started to inch back up. But now over the last month, we're starting to see it come back down again. And therefore you're going to see advertisements and whatnot everywhere regarding these rates. And the reality is that, you know, 90% of rates out there are in the 2% range today, right now, as we're speaking. So those of you that own homes, please take a look at your homes and see where you're at rate-wise. And if it makes sense to speak with me or your preferred mortgage professional to see if it's the right time for you to move forward. And for purchases as well, we all know how crazy the market has been. It's been absolutely crazy. And, you know, one benefit right now this summer, as opposed to late winter and early spring, is there's a lot more homes on the market right now than there were. The lack of available homes is really what brought the home prices up. And because there's more and more homes being listed, I follow all the stats and whatnot. There's more homes in most areas. You'll see that it's becoming a little bit more of a buyer's market. Not to say that the prices aren't high, but you might be able to negotiate some better terms than you were able to a few months back when there was less inventory. So that's a good time for those people that want to take advantage, including those of you that are aggressive enough and smart enough to also look at getting rental property. I know Dr. Chess is going to speak about that as well. And this could be the perfect time for you with multitude of different programs available. And I'll go into that a little bit further today. Dr. Chess.
Fantastic. I know that we are really in for some great information this evening. I believe that this information that you'll receive is going to help order your steps and give you the knowledge that you need to make decisions going forward. And so, what we'd like for you to do, Pastor Michelle is here. We'd like for you to enter those questions into your Facebook, put them in there on Facebook, And then as time permits, we're going to ask more and more questions from Khash. And there's no dumb question, all right? So we want you to ask because we want you to be informed. Khash, I have one question. There's
Sure.
someone has already asked us about HELOCs. What's your thought on HELOCs? Is it best to get a HELOC or just to refinance your home in its entirety? And what would be the difference?
Well, you really have to look at in a scenario like that, what's the rate that that individual has on their first mortgage right now, right? That's first and foremost. So many millions of people have refinanced over the last 18 months. That individual may have secured a great rate over this time. And if that person's in the 2% range on their loan right now, to do a cash out loan would bump you up into the 3% range. And they may not want to do that if it's a small amount of equity they just want to have access to. It's a case by case scenario, but home equity lines of credit are adjustable mortgages, just so everyone knows. So as the market improves at some point, your rate is going to go up as well. And so that's something to consider. And it could be beneficial to do a home equity line at the moment while the market is low and rates are low. And if you start to see it creep up over a 6-month period or 9-month period, you could reach out to your mortgage professional and look to combine them both maybe into a new first mortgage, which is fixed. That way you have that security of knowing that the rate's not going to go up.
Wow, okay, that's great. If you have any other questions regarding HELOCs, be sure to let us know. We have a question that has just come in. I have a question regarding Fannie Mae and Freddie Mac having expanded their eligibility on refinancing. Do you know anything about this? And if so, can you elaborate?
Yes, just recently. So the largest agencies for mortgages is Fannie Mae and Freddie Mac. They're the largest buyers of home loans. So what most banks out there, including the depository institutions, Bank of America, Chase, Wells, all these people, they try to formulate their guidelines and underwriting under what Fannie Mae and Freddie Mac accept, because they know that should they decide to sell off those notes at any point, that Fannie Mae and Freddie Mac will purchase it from them. So they want to always stick with those guidelines. And they're the ones who typically offer the lowest rates that you'll find out there. If your scenario is good to great, that's what you're accessing. Now, what they've done recently for individuals, because they know the home prices are crazy and they want to try to help stimulate people purchasing homes, is they're looking for this specific program that they're talking about is something for individuals that make low income for their counties, basically is what it goes off, city, county. If for your county, your average income is lower than the average, they've put these programs together for, for you to qualify for higher payments than you would typically, lower down payments than you would typically, things of that nature, really to try to bring those first-time home buyers to be homeowners as opposed to renters, knowing that rental prices have gone up quite a bit as well.
Okay. Tina, I hope that answers your question. We have another one. And then, I want you to just feel free to just flow as whatever you think we need.
Too. Yeah. I want to help people give a general guideline too, Dr. Chess, and that's most people right now, they would think, if I just ask people off the cuff, what do you think is the most important thing to qualifying for a home loan? Almost all of them would say, it's my credit score, right? And one thing to know about that is, though credit is important, credit is not the single most important thing. What credit determines more often than not is that, if your credit score is lower, you might pay a higher interest rate than someone whose credit score is, 800 or something of that nature. But it's not going to stop you from necessarily getting into a home. And so those people that thought credit were important, I just want to say one thing to you. And that's it's very important for these mortgage lenders and the credit bureaus and those credit reporting algorithms that they use. They want to know not necessarily car payments or fixed installment payments where you're just paying on time, of course, that's very important that you always make your payments on time. What they want to know is if we give you a line of credit, if we give you a credit card, who's in control of that credit card? As in, if we give you a $1,000 limit, are you spending $900 or are you spending $100? And if we give you 5,000, are you spending 4,500 or are you spending 2,000? So the magic number for the credit companies is that your balance is always under 30% of the limit. So it's not 33%, it's 30%. So whatever your limit is right now, you guys do the calculation at home, whatever your limit is on every credit card, for you to get A+ markings for that specific line, you want to maintain a balance under 30%. So if you're a little bit higher and you have the capability of bringing that payment down, do so. It's really going to help you. And, you know, doing things like this will help enable you to get the lowest payment possible when it comes time for you to look to borrow money. So that's the credit part of it. The next part of it, the people that don't answer that question, what's the most important aspect of purchasing a house? It's, oh, it's got to be my income. And that's, I would tell you, that's the second most important thing, but it's not the first most important thing. Your income for Fannie Mae and Freddie Mac, which we just discussed, those are the two powerhouses of the mortgage world. It's a pretty standard rule of thumb for them to qualify you for a house. If you're a W-2 employee, or if you get pay stubs, W-2s, the way they calculate is for you to qualify for a home, they're going to take a look at what your monthly payments are on your credit report and what your payment is going to be for the house you want to purchase. And the magic number for that is that your income, your gross income, before taxes are taken out, needs to be double what all these payments are. So if you make $8,000 a month, then you just need to make sure this house you're buying and whatever you have on your credit report, car payment, student loans, possibly credit cards, whatever those minimum payments are under 4,000 in that scenario, and you'll qualify. It's not anything complex. That's the number that they're shooting for. If you're lucky enough to be looking for jumbo homes, things over $1 million, $2 million, then instead of being 50% of your gross income, they're a little bit more conservative because there's more risk. They want to see you at 43% of your gross income. For those people that are wondering, how do they know what they get qualified for? That's the magic calculation for both. And I just wanted to end this part of it with the most important single thing for purchasing a home, be it your primary residence or investment property, is down payment. How much have you had a chance to save? That is singularly the most important thing. These banks, as we all know, are super conservative. The people that head these banks and their investors and whatnot, they're trying to maximize profit and mitigate risk. They don't want to put risk out there. So to mitigate risk a lot for people there's very few of us that are perfect across the board. So the ones that have, something maybe missing a little bit here, dinged up a little bit here, the way we counter that and compensate for that risk is by putting more down. So if someone has the capability to put about 3% down on a purchase, you really only have two options. You put 10% down on a purchase, now you have, 8 options. You put 20% down on a purchase, now you have 100 options. And that's just how it works. And, if there's any questions or if there's a big hurdle in your life, just know the number one asset you have to get past that is how much money you have in your bank account or how much money you have access to, which may include gift funds from family, parents, things of that nature to help out.
That is great. We have questions regarding some of the things that you have said. By the way, your friend Eric Hawkins is on this evening, and he says, Khash Benham, mortgages. And we know that you
I
do.
love Eric. Absolutely love Eric and Liz.
I do too. In fact, I met you through Eric, years ago. Right. And it's wonderful. But listen, here's a couple of things, and you may have already answered it. One has come. Can you clarify how the loan program works for people with low income? How does the monthly payment stay affordable? with that, Khash, I'm going to ask, I didn't bring this up earlier, but are you savvy with the, oh, what is it? What is that rental assistant program, housing
Down
authority
payment
program?
assistance, things like that.
Yeah, housing authority programs. Now they're trying to help their people to be able to purchase homes. So
Mhm.
that might go in line with this question that was just asked. Clarify how it works for people with low income.
Well, quite honestly, to go into a specific scenario, I could always follow up if someone emails me or calls me, after the fact. But in a general structure, each county has average income amounts. So people in San Francisco have the highest in California. So what might be average for San Francisco is very much different than what's average in Fresno, for example, right? And these average county limits, and we have to go check. We go into Fannie Mae's site, Freddie Mac's site, and they produce what the average income is. And that helps determine if you're going to be eligible or not. Because if you're over the average income, their mentality is, well, you really should be able to save a little bit to put whatever's necessary to put down. But they understand if, hey, as a household, if you're not able to make what, hopefully you would be able to make, in a better situation, they're coming through to help out. And there's multiple different programs. And as you said, Dr. Chess, there's multiple statewide programs, California, like down payment assistance programs and things of that nature, housing authority programs. And then there's also city specific programs. I recall back in the day, Oakland had a specific program that I encountered. Los Angeles County had a specific program that I encountered. So there are these things. You really have to do the search with your county treasurer, websites like that to figure out if there's something specific that you may have access to in your area that the rest of us may not throughout California. And outside of that, any specific stuff, I'll go into after the fact, and I'll spend as much time as needed to help answer all the individuals' questions singularly and one-on-one.
That's good information. I do have another question from Kathy Spearman, and she's asking, is it a good idea to take equity out of your home to purchase investment property? Your thoughts on that?
I think that's a very smart business decision. I think that's a very smart business decision because you're taking, I'll use the terminology debt equity, because you cannot use that equity until you sell the house or refinance and take cash out. So it's sitting there, which is great, but it's not being used. So if you take that passive equity and you make it aggressive and you utilize it to go make some income come in for yourself,
Okay.
passive income, rental income, that's going to work out for you. And that's going to be a much more, I would say, intelligent decision with that money. But there's one thing I want to keep in mind. I've been doing this so long and I've seen so many cycles. What a lot of people were doing in 2006, 2007, when prices were going through the roof back then, is they were leveraging out all their equity in their property with all these plans. But as soon as the market shifted, and the rates went up, then the payments became difficult to make.
Okay.
So I would say, number one, talk to your mortgage professional who knows your scenario the best. But you really have to make sure that whatever money you take out, and we all know we need a little bit of something to buy rental property, more often than not 20% down. So you're taking out 50, 100,000, whatever it is. You want to make sure you could afford that payment and you have some months of reserves put away, maybe 6 months of reserves, just in case the market shifts, just in case, like COVID, a lot of the renters weren't able to pay and they had moratorium where they didn't have to pay. So you just want to be careful that you don't put both properties at risk by doing it this way. So it's very important to talk to someone and see what your individual risk threshold is for these type of maneuvers.
That's great. So they would run the numbers to help determine what your risk threshold would be. Is that right?
That is correct, because you could purchase another property. You have no idea when it's going to go get rented, if you're going to get the amount you really wanted for the rent, if it's going to cover that payment. And, you just want to make sure that the overall picture is viewed by a professional and they could hopefully just guide you to the right answer instead of, hey, I could just do the loan for you.
And you're one of those professionals, right?
I take the time. I really care about people's well-being.
Absolutely. I know. As I said, for those of you that are just joining us, I strongly believe Khash is a man of tremendous integrity, and I've worked with him for many, many years now, and I really appreciate his information, his insight, and certainly his integrity. And he's not just trying to get your money, he's going to let you know whether or not it's solid and it's a good idea. I really appreciate I have had, how do I say it? Maybe people with not as much integrity. I've had those type of mortgage brokers before in the past because we had a lot of rental property. So I do understand that. And I really appreciate him. We have a question that has come in about home buying for a veteran. And I'm not sure what the question is, but maybe talk to us about home buying for a veteran. He just asked, how about buying for a veteran?
Veterans could go up to 100% financing any home that they want to purchase. There is that debt to income rule, that 50% rule that we discussed earlier.
Mm-hmm.
You know, the only loans that doesn't apply to is VA loans and loans for veterans, where they have a separate calculation that they do. And, you know, they really want, you know, the government really wants to reward the veterans who put their lives on the line and the dedication by helping them getting to a house. So they don't use that hard and fast rule. It's backed by the government, so lenders don't feel as risk as well to add that overlay. So they use a different way to calculate it, but VA loans are in essence the lowest interest rate loans you could get out there. And, you know, you could do it with zero money down and you never have to pay private mortgage insurance. And Dr. Chess, you've experienced this as well. You just have to figure out if, you know, the VA funding fee, and these are specifics I'll go on with you. VA charges a fee to offer these loans out to veterans. And the first time you use it, the fee is less than if you've used it in the past. And that's something that you have to consider and something that you have to review. But if I had to pick one loan that I consider the best loan to get into a home, it's 100% a VA loan, 100%.
Okay, that's great. So the fee changes on a VA loan depending on the number of times you say you use it, or is it refinancing, or is it the number of homes you purchase?
All of it. That's absolutely right. There's a first use and subsequent use, and there's a difference for purchasing and there's a difference for refinancing.
Okay. And
there's actually a difference for if you go to the full 100% or not, because there's still that risk grade with it. If you don't go the full 100%, it's a little bit less intrusive for you. But the fact that you could put less than 20% down and avoid PMI, and something that the listeners should know, government-backed programs like USDA, like FHA, like VA, because the government's actually backing these programs, they allow your FICO scores to be lower than your Fannie Mae and Freddie Mac loans that we discussed earlier. They have a hard and fast rule of what the lowest credit score can be for a conventional Fannie Mae and Freddie Mac loan, and that's 620. So your income could be fantastic, your reserves could be fantastic. If you're at 619, you can't get in to that program. But government loans, VA, FHA, USDA, they actually aren't credit score driven at all. If you read the rules on it, there's no credit scores that they utilize. You could qualify no matter what, but banks still get graded on their risk, how many foreclosures happen, how many late payments happen with loans that they produce. So they always add an overlay. Usually, I'm sure a lot of you have heard that the overlay was 640 maybe as a credit score. Other places was 580 as a credit score.
Okay.
More often than not, though, because we've had so many years of low foreclosures and whatnot, the credit scores now go down to 500. So if you have 500 credit score, they'll let you go. Usually they want to see you put 10% down in that scenario if you're under 580, but you could still get in. I mean, you know, they're trying. They're really trying to get you in with low rates as well. It's not a situation where your rate jumps through the roof because you have very low credit. It's just, you might pay a quarter, 0.5% higher, something that's reasonable though, given the risk.
Wow. That's good information. So it's really beneficial. I mean, today we're looking at a market where rents are, $1,700 for a one bedroom,
Right.
you know,
Crazy.
so you can pay that much and write off your, property taxes or interest on your property if you were just buying a home. So it's really advisable to invest in yourself in home buying.
Hmm.
And I really hope people understand that, it's really interesting also what you're saying regarding credit and the credit score. Now, I didn't realize you can purchase a home with a credit score under 580 or under 600.
Hmm.
The basis had always been years ago 620, but now to have a good, what's considered a good credit score, it has to be over 700. Isn't that right?
That's 100% correct. Because the maximum credit has gone up over the years, like maybe when we were growing up, if someone had 700, I mean, the world was their oyster. They could get pretty
Right.
much anything they wanted as fast as they wanted. They couldn't offer you a loan quick enough. Now, believe it or not, because credit scores are in the mid 800s, average credit is between 680 and 720. That's what you get dinged if you're under 720. You get dinged when you get it. It's not like the lenders don't fight for you the same way as if you're over 720. And so there's, a little bit below average, which would be 680 to 700. And there's just a stronger average or good average, which is 700 to 720. If you want the best rates on the market though, you want to be 740, 760 up. And there's multiple ways to do that. One is make your payments on time, barring any things that happen in life, which it does. And the other is just kind of playing their game. And their game is like that 30% number. I didn't know that. When I was growing up, I just getting into my credit, a young man, I had multiple credit cards, 3, 4 credit cards, all small balances. Then someone came along and said,
Yeah.
hey, we'll give you this high credit card. Why don't you transfer all your balances? I'm like, well, that sounds smart. I'll have 4 credit cards now, but 3 of them will be zero, but one of them is going to be maxed out. And
Right.
come to find out that that's worse than keeping all 4 at low balances and moving forward that way. So and they purposely keep it vague. They don't want us to know exactly what's going on. Then you could question them. They don't want to get questioned. They don't want to be taken to court.
Yeah.
So they purposely keep it vague, and it's up to us to know how to work it and how to maintain our own personal credit.
Wonderful. I have a question, and Brendetta, I'm not quite sure, but I think you're asking, is there a difference in purchasing a home versus a townhome or a condominium for a first-time home buyer?
There's a couple differences. Number one, the number one buyers of home, and this is going over the last 100 years, this is not new data. The number one buyers of homes are first-time home buyers. And that's families that are growing, right? So, you have a couple, they're together, they're about to have their first child, their apartment was too small. Now they dream of the white picket fence, a nice house, neighbors, all that stuff. So, and you got to remember, it's not just the coast, it's all the middle America too, where condos and townhouses are not as prevalent in numbers, right? For us along the coast with the crazy prices that we have, we're very much used to, it's almost the same thing for us. But middle America, it's not like that at all. It's hard even for them to fathom not getting a, stick-built family, single family residence. So overall, there's 2 risks with buying a townhouse or a condo. For homes, if you put 20% down, example, let's say as a hypothetical, if your rate is 3%, at no points for a single family, if you buy a condo with under 25% down, so there's a 5% hit on the risk factor because it's harder for them to flip if you foreclose, harder for the lenders, the banks to flip that condo or townhouse compared to a single family, your rate's going to be probably 3.125. In that same scenario, everything about you is exactly the same FICO, same income, everything, just because of that risk and the numbers that show over the last 100 years. And one other factor is the condo or townhouse project itself has to be approved by Fannie Mae and Freddie Mac. And sometimes it doesn't. If there was hypothetically faulty piping, faulty material that they use for the piping, and a lawsuit entails, and every single unit of a 300 unit condo was using that same piping, it could be a problem. And Fannie Mae, Freddie Mac might say, this is too much risk for us to lend until the litigation finishes. Or if there's too much of a percentage of HOA dues that are behind, they'll say the same thing. And this same scenario. So if something happens and they have to change the piping, well, where does that come from? The HOA has to cover those fees. So if all of a sudden you have to fix 300 units, your normal HOA dues that you were taking to maintain over the years is not going to suffice. So all of a sudden your HOA amount could go up $100, $200 for, they could say for the next 3 years until we even out. Right. And then some people fall behind, and because they weren't ready for that increase. And if they fall behind, it could be on fixed income. If too many people fall behind, that's a risk for Fannie Mae and Freddie Mac again. And so it's a little bit harder to qualify for a condo and townhouse, and it doesn't necessarily affect your rate. It all depends on how much you put down.
Okay. I have a question since we're talking about that. What if someone owns property, say just land? Say I have 100 acres of land, haven't built anything, haven't put anything, and I own it outright. But I have not been able to make the tax payments, property tax payments. I'm nearing my 5th year, right, where they can foreclose on that property. Would it be wise for me to refinance or to finance that property? If so, would I be able to if I don't have much income?
Well, there are lenders that build on undeveloped land. There are lenders that build, but it's very low loan to value typically, under 50% of the value, things of that nature, because there's a lot of risk with those type of properties. And if an individual is behind on their taxes, that would have to be paid before that individual could get any cash out. So if they wanted to take out 50,000 and they owed 8,000, that 8,000 would come out first, and then they would get what's remaining. So I see. But it's a lot of risk with undeveloped land because the collateral is not really there. You could have the greatest plans set. I'm going to build 4-plex over here and build a garden and do this and that. But until it's built, it's a lot of risk. And if you run out of money halfway, you're just sitting there with, a couple things done. So it's a lot of risk, but there's definitely 100% lenders that are out there that do lend on undeveloped land. It's important to know where the land is. Is it close to a city? Is it very rural? Is it even zoned? What is it zoned for? Is it just zoned agriculture, or is it zoned for residential? Things of that nature.
Okay. All right. And that makes sense. We have a couple of more. I have questions regarding that. Let me just ask this while we're there regarding land. If someone were to purchase land and their intent is to build a home, so would you get? They would purchase the land, and I guess get a building loan. Is that right? And it's something that you handle as well, construction loans?
Construction loans I've done in the past, but I got to be honest, it's not my forte. As in, it's so few and far between that comes my way in regards to that. I always advise people, talk to the big bank. Your depository institutions typically have more of an appetite for that type of construction lending. And they may be able to offer better terms. It just comes across my desk so little. And we close 300-400 loans a year, but it's still like those specific type of loans are very rare that it comes across my personal desk. So I would advise, I'll help though answer questions. I just probably, I would just say, I'm not the guy to help you see it through.
Okay. All right. We have several questions, Khash. You ready?
I'm ready.
All right. Here's one. What lending and home buying advice can you give to someone who will be relocating to another state?
Well, first and foremost, wherever you want to buy a house, if you're trying to get financing for the house, one of the most important questions is, well, like, where are you working? It has to make sense. Like, if you work in San Francisco and you're saying, I want to buy a house in Palm Springs, which is in state, but I want to buy a house in Palm Springs, their first question is going to ask, well, how are you going to maintain your income moving that far away from your job site? What we've seen with COVID, though, is that there's so many people working remotely that, it's not an issue, but you would have to get something to substantiate that, a document, a lender, verification of employment to say, our borrower is okay living in Tennessee, in Las Vegas, while still working somewhere in the Bay Area, for example. So it doesn't make a difference in regards to rules and things of that nature, because Fannie Mae and Freddie Mac are nationwide, regardless of where you live. It won't necessarily play a part, except for the fact of if you reach county limits in those areas. And that's another topic, but across the nation, there's one county limit, and then mid 500,000 range. And then, some places, big cities, you could go up to 800,000, 822,000. So, but there's no other rules or restrictions. So if for you feel like with the money you make out here, you want to live somewhere else, cheaper cost of living, things of that nature, it won't affect your rate or anything else. You'll still be able to benefit from today's marketplace. I cannot hear Dr. Chess as of this point, but I could read one of the other questions. If you have a loan balance.
Here we go. Can you hear me now?
I can hear you now.
All right. Yeah, I told you we all do it. And I got kicked out. That's a whole nother story. Here's a good question. And people would need your advice on this. And also I want to let everyone know Khash's email is on our website as well as on our Facebook page. So you can send him personal questions directly. So here's the question. If you have a loan balance, is it good to make a large payment toward your loan balance? For example, if you have a $272,000 balance and would like to make a payment of $72,000 toward that balance, is that a good move?
All right. So I'll answer that in two parts. Number one, mortgages are simple interest. They're fixed payments. So even in that scenario, if you put that much money you bring it to the table, it's not going to change your payment. It's just going to lower your term. So if you had 20 years left and you bring 72,000, well, maybe now you'll have 16 years left, for example, as opposed to 20. So if you want to bring that money in, remember this terminology. You want your loan to recast. And what that means is that they'll reduce the balance to 200,000 in this case, and then adjust the payment to be paid off the remaining term of the loan under 200,000 instead of 272. So you'll be paying less. Now, what I would tell people, and I have to put this out there because this is some of the compliance rules as well. I'm not a financial planner or advisor. I could tell you off my experience and my thinking because I have access to money to be able to do this type of stuff as well. If you have to think about it. If you have a home loan, and let's say it's 3% right now, you taking 72,000 and bringing down something at 3% after taxes, because you write off interest, you're at 2% basically, 1 point something for most people. Is there potentially a better use of that money? And that depends on your adverse to risk or not. You could put that same money in a mutual fund, moderately aggressive mutual fund, and make 10% per year, right? Yeah. I mean, if you're very risky, you could buy Bitcoin for, and it could go up, down, who knows, right? So it's really about your appetite, but just make sure if you're going to bring that large sum of money to the lender that they will recast your mortgage, which is change your payment to be now based off the new lower principal balance.
Okay. This same person says, what is a shortage payment?
I'm not 100% sure what she means by that. I mean, was she short on escrow before or something like that, where she had to make up a payment or she had a modification? I'm not 100% sure what that means,
Okay.
but yeah, so I don't want to go, I could go into so many directions, conjecture, but we'll leave that be. And again, I'll be more than happy to answer after the fact.
Okay. All right. Sounds good. I think Pastor Michelle, was that the last one? Is there another one coming through?
Yes. Is now a good time to take cash out of your house?
Absolutely. Absolutely it is. And I say this only because rates are very low right now. That is the reason I say that. So if you cash out, now remember, cashing out above, like if we're talking about a first mortgage, cashing out above 75%, I mean, you could go up to 80%, but they're going to ding you. That's the maximum cash out you could get, is up to 80% of the value of your property. So if you utilize that, then just know that your rate's gonna be higher than if you were taking up to 75% or even lower loan to values. But if you need maximum cash out, you have the choice of doing it on a first mortgage, or you have a choice, as we discussed in the beginning, of taking out a home equity line of credit and qualifying that way to get out the cash out that you need. And one other important part when it comes to taking cash out of your home is you have to decide if you need that cash at once or if you just want access to the cash. And what I mean by this, if you're looking to purchase another property and you already have identified the property, well, you need it immediately to put it as a down payment. But if you and your spouse decide, you know what, we really want to put a pool in and we want to remodel X, Y, and Z, well, you don't need all that money at once. You need it over time. And if that's the case, a home equity line of credit might be the best course of action for you, which I do not offer. So it doesn't benefit me whatsoever. I'm trying to help you guys out. And home equity line of credit, you'll get access to whatever the limit is for that equity line. It could be 100,000, 200,000, whatever it is. But you don't start paying interest until you pull the money out. So if you're remodeling your house and you do your kitchen first, well, you take out what you need to do your kitchen and you make payments on that. Then when you want to build out the pool, then you pull money out for that and then you pay on that. So it all depends on how quickly you need the money. And but remember, guys, one more thing: rates on first mortgages are always lower than second mortgages, and these home equity lines of credit are going to have a higher interest rate. They're going to be 4%, 5%, depending on the scenario, compared to getting cash out in the low 3% range, for example.
Okay.
Can I add
Go ahead, Pastor Michelle.
To the HELOC question? It's being said that banks are going to start lowering the regular lines of credits that are out right now.
Yes.
Will that affect HELOCs as well?
The number, absolutely. And I'll tell you, and this happened to us when the market crashed in 2008. I had an equity line. I didn't even use it. And they just closed it, which the banks have that right to do that. So I wasn't behind, wasn't late on anything. Credit didn't drop. They closed it because they just, they had to stop the risk. Scared people would just take the cash out and let the properties go, things of that nature. So right now as well, it's a moment of turmoil. And, you talk to 20 financial gurus, advisors, 10 of them will say the market's going to keep increasing. 10 of them say, dark clouds are ahead. So it's hard to gauge it exactly, but Wells Fargo for right now, I think they stopped all their personal lines of credit, closed it or stopped it. There was something in the news, 2 days ago on it. And so you will see that with equity lines as well. Just because you get an equity line for hypothetically 200,000 on your property doesn't mean that they can't cut it in half or close it all together or things of that nature, right? So it can happen. I think it would be case by case, but what I read with one bank, now it was just one bank, it wasn't the industry, but each bank's appetite for risk is a little different, and some of them forecast different things happening at different times, but they can, absolutely. So if you want to avoid that, you could just take cash out on it first, and no one could do anything about it at that point.
Did you have another, Pastor Michelle?
That was it. Thank you.
I have a question regarding term loans, the term of loan. So is it best to get a 15-year or 30-year? And currently, if you have a 30-year loan, say you're in it for maybe 25 more years, you're 65, 70 years old. Should you maybe refinance and get a 15-year loan? Would the payment be about the same, especially because of the rates these days? Or what do you think?
Well, you know what, if you pass the halfway point of whatever loan term you might have had, so let's say you had a 30-year fix and you've made 17 years of payments on that one loan, you just never refinanced, maybe you had a bad experience, never wanted to go through it again. At that point, the bulk of your money already is going towards principal, no matter what the term of the loan is that you get, be it 10-year or 30-year. The initial portion of that term, most of the money is going towards interest. I mean, you guys all see it on 30-year fix, where it seems like 95% of the actual payment goes towards interest, but that's like a seesaw effect over time. Your interest amount goes down, your principal goes up. So it really depends on your scenario. It's not a hard and fast rule that it should be absolutely and lowered. It really depends on what the rate you have now and what's the rate you're being offered. And if someone's on fixed income, I mean, just remember, reverse mortgages are also an option where, instead of you cutting a check for your payment, that payment is coming out of your equity. It's no more risk than a normal loan, but your rate is like about 1.5% higher than what the market is doing. But that's popular with people too that are on fixed income. But it really depends on what the actual numbers are. If you're at 3% now and trying to go to 2.25% with a lower term, depending on your loan size, I don't know how much that would help you. I'd have to, the great thing with this is it's not all conjecture, it's actual math, actual numbers, and we could break it down and see at what point are you recouping whatever costs you would have to pay, and at what point do you start benefiting from reducing that term.
Okay. Great.
I see another question here, Dr. Chess. I see, how does the purchase of mobile homes work?
Okay.
Buy the mobile home as well as piece of land. It all depends. Some mobile homes are on mobile home parks where you lease the land, and you could still get normal loans for those. The lease just has to be 5 years more than the term that you're doing. As in, if you want a 30-year fix, the length of the lease has to be minimum 35 years. If it's 25 years, the maximum term you could get for leasehold land is 20 years. You have to have a 5-year gap in between.
Okay. Khash, anything else you'd like to share with us?
Well, it's reverse mortgages, just to let people know. I mean, reverse mortgages, the largest reverse lenders is actually, it's someone I know personally, is right here in Southern California. That had a bad connotation years back, and I'm not sure where it comes from. As I'm getting older, a lot of the people that I interact with are now of retirement age as well, just as we've all got older over the years. And so we have these discussions all the time. And I personally think reverse mortgage is backed by HUD, same as FHA. It's a government program. There's no one offering their own, mom and pop reverse mortgage, right?
Okay.
All it is, I mean, if you have money in a bank account and then you have your equity in the house, in a forward mortgage, you make a payment, and then the balance goes down too. So it goes in line. In a reverse mortgage, you don't make a payment, so the amount in your bank account goes up, but because they pull the equity out, your balance goes up too. It's very, it's very even. The only difference between the two, it's almost guaranteed qualifying for a reverse mortgage. especially for people that are on fixed income and just want to have that, $1,000, $1,500, whatever it is that they have. They want to be able to utilize it, not borrow money from their kids and things of that nature. It's a good option. Just keep in mind that the rate, like for example, if a normal FHA loan is 3%, that reverse mortgage is going to be at a higher rate. It's like a courtesy that they pull out where they don't collect the money from you. That courtesy comes at a premium. So you would be paying, for example, instead of 3%, 4.25%, for example. And so just keep that in mind. If you're able to make the payments, great. If you want to have a little bit more freedom with your fixed income, then I think reverse is a great option. It's something to discuss, and they require you to do home counseling. You can't even get a reverse mortgage without doing home counseling before even your application. So, it is something that they want professionals to talk to you about to see if it's the right solution for you.
What's the age that you
62?
can do a reverse mortgage? 62?
Mm-hmm.
Okay. And then what happens when the person is deceased or becomes deceased?
People who inherit the home.
And you know what? This happened. My younger sister's best friend. She was helping. Our father was sick over the years. He had a reverse mortgage, and so I know exactly what happened. I was intricately involved, and I spoke to all the parties as well because she leans on me for the mortgage stuff. So they actually give you more of a time. Let me explain this. If you have a normal mortgage, we'll call it a forward mortgage, just your standard 30-year fix right now. If you miss payments and it goes into foreclosure, if you miss your third payment, they're going to do a notice to default. They're going to get you ready to sell the property within, 6-9 months, right? And no one else has a chance to, all someone else can do is buy it. There's no chance to refinance or anything else. And a reverse mortgage, if someone passes away, they contact you like, listen, we're going to give you some time. Every bank's a little different, but I would say she got up to a year, just so you guys know. She had a year's time to figure out if she could qualify to refinance herself or just sell the property, right? Or just give the property back to the bank without going through all that. But you do get some time to figure all this out. They give you the chance to, depending on who owns the house after that individual passes. If it's your spouse, she could still stay with the reverse mortgage. If it's like your kids or someone that received the house in the will, they have the option of refinancing into their name or, selling the property. The banks are not in the business of holding actual properties. There's no realtor that works for Bank of America or Wells Fargo or Chase. There's no realtor that does that. So they really don't want to. They want to give you every chance that you have to refinance or sell the property and go on from there. So they'll give you as much time as you need as long as you're in communication with them. But I would say expect to have 6 to 9 months is what I would say is typical, 6 to 9 months in a scenario like that.
Okay. Pastor Michelle, any other questions over there?
No more questions.
Anything else, Khash, closing statement? Anything else you want to leave with us?
Guys, I just want to say, I just want to say overall, the rates are very good right now. And when we spoke last year, Dr. Chas and Pastor Michelle, we, the market was just getting the hottest it's ever been, which was last August, September, was just the peak. And, I've been doing this 20 years. I was the peak of it. And then it was still hot. Then rates started going up in February of this year. They started going up and they remained up. They just came down last couple of weeks to very close to where they were at that time, right? So if for whatever reason you were busy traveling, if you didn't take advantage of it in 2020, I suggest taking advantage of it now. I'm not a fortune teller, but we're getting to the point where we're bottoming out. We're bottoming out with the rates. They're never going to go to 0% or 1% or anything like that. So we're getting at that point. Take advantage. Don't be greedy. If it makes sense for you, if you really wanted to buy a house, I know prices are crazy. The only good thing I can tell you about that is someone's taking advantage of this hot market to sell in the neighborhood that you specifically want to live at. Now, I don't know if you could afford it or not, but rates are low. They're helping you potentially get into that one neighborhood you wanted, because I guarantee you there's someone on that block, someone in that, couple streets that you love that's selling, that's taking advantage. So it could be a great time. Speak with your realtor, see what's out there, talk to a mortgage professional, see what you could afford. And just know that there is now many programs out there. It's not just show me your tax return, show me your W-2s. You could get qualified with no income verification, with just assets. You could get qualified with cash flow programs, where just like if you could show that money is coming in and out of your account every month, you can get qualified that way, regardless of how you write your taxes. Maybe you write it as a loss, but they'll look at how much money you actually move. There's a lot of items out there. There's a lot of programs out there that we couldn't have this conversation 2-3 years ago. We really couldn't.
Okay. One thing that we talked about last year, and I actually had a member to take advantage of it, and it was last year rates were low and prices were going up. And the question came up, should we wait for the prices to go down? But then we talked about if the prices go down, the rates would be going up and you'd probably be at the same level. And they took advantage of that and were able to purchase a house last year. And so I want to make sure that everyone knows that. Don't fear the price. Don't fear the cost of the home right now, because with such low interest rates, you can probably afford more than what you think you can afford. And I appreciate Khash laying it all out. This is how you can purchase a home. If you're a veteran, up to 100%, take advantage of these low rates, take advantage of this season. Khash, we appreciate you so very much. Again, his information is on our website. It's also on the Facebook page. I want you to ask him. He can run numbers for you. I go with him. I just say, okay, look, can you run these numbers? Tell me, does it make sense? I need to know if it makes, what would happen if I did this? Okay, here's scenario B. You all know me. I want to know A, B, C. And he'll run the numbers for you. And he's excellent at what he does. And again, a man of integrity. Thank you so much, Khash, for being with us. I pray all of your questions were answered. Go back and listen. If you got on late and you have questions, more than likely it's been answered. So go back and review this session and you'll get an understanding and clarity for many of those questions that you may have. We appreciate you so much. Let Khash know how much you appreciate him, everyone. Thank you so much.
Thank you. Thank you, Dr. Chess. Thank you, Pastor Michelle.
You're welcome. Thank you.
In closing, if any of you guys ever need to look at some properties, talk to Eric Hawkins, Linda Hawkins. They can help with MLS listings and they can help you potentially find the house you want in your neighborhood.
I was going to mention the shameless plug he just put out. See him put the shameless plug out. He said, get qualified with Khash first and then come to my webpage, my website.
Did he do that? Did he say that?
Yes,
I missed it.
Shameless plug. He said, go to hawkinshomepage.com.
Thank you, guys. Much love to you all. Much respect. And, wishing a prosperous year for you all.
With the right home, I will add that.
Yes, you want to get qualified first, so you're looking at what you can buy.
That's right.
Way to make it go faster and go smoother for everybody.
Yeah, don't spin your wheels on something you can't afford. That's correct.
That's right.
Thank you, guys.
All right.
Thank you again.
Thank you,
everyone. And Khash mentioned something. He says, I'm not a financial planner or financial advisor. We have one coming the last Wednesday night of the month. Today is the 14th. So on the 28th, we're going to start at 5:30 instead of 6 o'clock. So I want you to put that in your notes. We're going to start at 5:30 instead of 6 o'clock. And we have a financial planner, financial advisor that can answer a lot of those questions that you even have regarding paying the $72,000 down, or how you should handle your finances, investments, what that would look like. And so I really want you to get back on, come on with your questions. They're going to do their presentation but they will answer as many questions as possible. I appreciate Khash. Next week, we're going to be looking at estate planning. Listen, you all own homes, you have businesses, you have finances, you have investments. You need to understand about estate planning. Let me ask you this. Have you identified one person that is able to make a decision for you, for your life, if you're not able to do it? If you were put on life support, if something happened to you, who's going to make the decision for you for your life? And we need to start thinking along those lines. Also, how to do a will and a trust. What would a post look like? And so these things are very important. I want you to be on next week. We have a wonderful attorney out of Sacramento, Delonda Coleman. She's going to be with us, and she's going to share some information on estate planning. We need this. We need to understand this. Don't just let your estate go to the state. Let's plan and let's put everything in order. All right? Amen. God bless you all. Remember our scripture, that a good man guides his affairs with discretion. And I want you to hold on to that. Let's take a moment now and let's sow seed. If this has been a blessing, let's sow seed. We believe in the total man. So these wisdom sessions throughout this entire month are valuable to us as sons and daughters of the Most High. We believe that we want our business to always be in order. And how do we do that? With information. We need to know what to do. We need to have an understanding of the times. And God has given us men and women who are very savvy in these areas, and we want to take advantage of it. All right? Let's sow seed. Lift that device up. Father, in the name of Jesus, we thank you for seed to sow tonight. You give seed to the sower and bread to the eater. I decree and declare more seed. Thank you for opening the door for those that desire to purchase property in this season, those that need to refinance. Give them wisdom, God. You've given us the information. Now order their steps and direct their path. We give you glory, honor, and praise. We declare no lack in the lives of your people. In Jesus' name, amen. Amen. All right, praise the Lord. I decree and declare over each and every one of you that you guide your affairs with discretion. You're able to make an intelligent decision. You're able to make an informed decision, not off the cuff, not off of your feelings, but because you have been informed, you can make your decisions with discretion. So I bless each and every one of you. We look forward to seeing you at 6 a.m. prayer tomorrow morning on the line. God bless. And don't forget, Khash, you can look at his website, not website, but his email address. It's on our website. It's on our Facebook page. And you can contact him personally. And he will answer your questions and he will be available to help you. All right. God bless you all. May the blessing of God that makes rich and he adds no sorrow to it be your portion. In Jesus' name, be blessed.